A company everyone's heard of, SpaceX, OpenAI, Stripe, finally files to go public. The countdown begins. Analysts throw out valuations. Social media lights up. Financial media runs the story on a loop. The company that changed everything is finally available to ordinary investors. It's a compelling story, and it's almost perfectly designed to make you make a bad decision. Because here's the uncomfortable truth. The IPO everyone wants is rarely the investment everyone thinks it is. Today, we're pulling back the curtain on why the most anticipated public offerings are often the most misunderstood, and what that means for your money. Imagine a company that has spent 10 or 15 years growing in private. Its revenue is increasing. Customers love the product. Investors have poured billions into its growth. And suddenly, the public is told that shares will soon be available. The media treats it like a major event. Financial television covers every development. YouTube creators rush to explain why this could be the next Amazon. Investors begin planning how many shares they want to buy. The excitement builds long before anyone even discusses the price. And that's where the first problem begins. Most investors see an IPO as an opportunity to buy into a great company, but that's not how the company sees it. For founders, venture capital firms, and early employees, an IPO is often a liquidity event. It creates a pathway for early investors to eventually turn years of ownership into cash. That isn't a bad thing. It's exactly how the system is supposed to work. But it's important to understand that the IPO is not being created because public investors need an opportunity. The IPO exists because existing shareholders want access to public capital markets. When you understand that distinction, you begin to view IPOs differently. Imagine a company born at $100 million valuation. It grows to $1 billion, then $5 billion, then 20, then 50. At every step along the way, private investors were there. Venture capital firms, institutional funds, insiders. They captured each wave of growth as it happened. By the time you see the IPO roadshow, most of that journey is already over. That doesn't mean the company stops growing. Many do keep climbing, but you're not buying the scrappy startup that made early investors rich. You're buying the mature business that resulted from it at a price that reflects everything it's already become. The story feels new because it's new to you. The company isn't. There's a force more dangerous than any bad stock pick. It's the fear of missing out. Investors remember Amazon, they remember Google, they remember Nvidia, and what happened to everyone who passed. Those memories don't just inform decisions, they hijack them. So when the next exciting IPO arrives, something subtle shifts. The question stops being, is this company worth the price? It becomes, how do I make sure I own it? Participation replaces valuation, and that's when prices start floating free from reality, held up not by fundamentals but by narrative. The story becomes worth more than the numbers, until it isn't. There's another problem most retail investors don't talk about, and it might be the most important one. You are not playing on a level field. The institutions that dominate IPO allocations have spent months on these companies before you've read a single headline. They've sat across from management, they've built the models, they've stress tested the assumptions, they know where the bodies are buried. You got a CNBC segment and a Reddit thread. That's not an insult. It's just the reality of how information flows in financial markets. And when excitement is running hot, that gap becomes a chasm. But here's where it gets interesting. The same conditions that make IPOs dangerous for impatient investors create something valuable for patient ones. When everyone else is chasing the opening bell, waiting becomes a competitive edge. Information catches up, hype fades, and eventually the business has to prove itself on its own terms. Here's a strategy that will never go viral. Wait, that's it. Don't buy on day one. Don't chase the opening pop. Don't let the countdown clock someone else built pressure you into a decision, because 90 days after the IPO, something quietly remarkable happens. There are new financial reports. There's a track record of management operating under public scrutiny. There are analyst models with real numbers attached. And the crowd that was screaming about this company 3 months ago has moved on to the next one. The noise clears. The business remains. Waiting doesn't make the risk disappear, but it trades the worst kind of uncertainty for something you can actually analyze. You're no longer betting on sentiment. You're evaluating a company. The opportunity doesn't vanish because you were patient. If anything, it sharpens. And in a market full of people desperate to be first, being willing to be second is its own edge. This might be the single most important idea in investing, and it's the one most people never fully internalize. A great company and a great investment are not the same thing. Think about what that means. A business can have iconic products, visionary leadership, explosive revenue growth, and a fan base that borders on religious devotion and still destroy your wealth if you pay the wrong price for it. The reverse is also true. A struggling company, one the market has given up on, can become one of the best investments of your life if the price is right. The variable that separates a great company from a great investment isn't the product. It isn't the CEO. It isn't the revenue growth. It's the price you pay. So the next time you find yourself asking, is this a good company? Catch yourself. That's the wrong question. The right one is harder and less satisfying. Is this price justified by what the business is actually worth? Because even the greatest company ever built can hand you disappointing returns. All it takes is buying it at the wrong number. The next blockbuster IPO is coming. You won't be able to escape it. The headlines, the takes, the thousands of investors convinced that missing it would be a mistake they'd regret forever. Maybe they're right, but the investors who build lasting wealth are rarely the ones charging toward the opening bell. They're the ones willing to wait, to ask harder questions, to let the hype burn off and the business prove itself. Patience, discipline, valuation. That's what separates investing from speculating. The best opportunity is almost never found at peak excitement. It's found in the calm that follows. That's where we look. Thanks for watching. This is The Solo Investor.